The 2026 federal budget just rewrote the rules for property investors. Negative gearing gone on existing homes transacted from this point forward. Capital gains discounts replaced. Trust distributions now taxed at the entity level. And there's 2.26 million investors in this country who need to understand exactly what that means before their next move. My name is Richard and welcome to Ron's Industries, where we're pro-wealth, pro-growth and pro-real estate. And in this video, we're looking at the 2026 budget's property investor changes, what they actually mean, what the numbers say, and where the risk and the opportunity now sit. So let's start with the most talked about change, and that's the change to negative gearing. Now, the government has not abolished negative gearing, but they have split the rules depending on when you bought your property. This is really important to understand because the details and the explanation directly from the government cabinet have been vague, especially in recent times, and the detail is where the action is. Now, here's how it breaks down. If you currently own a negatively geared investment property, you're grandfathered. That means nothing changes for you on that specific asset. Now that's a relief for a lot of people. But if you buy a new build from the 1st of July 2027, there's also no change to the current rules. You can still negatively gear on a new construction, and this is deliberate, and we're going to come back to why in a moment. But if you purchase an existing home, an established dwelling from this point forward, negative gearing is off the table. You won't be able to offset losses from that property against your taxable income. Now, let's put some numbers into it because I think that there's a lot of confusion in the market about what negative gearing actually is and what it isn't. Now, according to the ATO, there are currently 2.26 million property investors in Australia. That represents around about 8.16% of the population. And this is actually down from 8.7% of investors in slightly older data, which tells you that the investor base is already contracting. Of those investors, approximately 49.4% are negatively geared. So what does negative geared property actually look like in the dollar terms? Based on current averages, a single tenant residential investment can already have an investor about between $14,000 and $15,000 underwater per year before you factor in things like council rates, body corporate fees, and other holding costs. And here's the thing that I think is critically misunderstood. Negative gearing has never been an investment strategy. It's a tax treatment applied to an unavoidable cash flow problem. The property itself is the strategy. The negative gearing was just a partial offset on the pain of holding it. You don't willingly hand over $15,000 of your own money to get 30 cents in the dollar back from the government. That's $4,500 returned on a $15,000 loss. No serious investor has ever sat down and said, I want to lose money this year. The cash flow is the issue. The tax offset was simply taking some of the sting out. So, removing negative gearing on existing homes does not make those homes suddenly profitable. It just removes one of the partial buffers that made the loss more manageable. And for investors running feasibility models on established property, that buffer mattered. Now, the second major change is to capital gains tax, and this one hits differently. The 50% capital gains tax discount, the concession that has been placed for over 2 decades, allowing investors who held a property for more than 12 months to halve their taxable capital gain, is gone for existing properties. In its place is an indexation model. Now, under indexation, capital gains tax applies to the profit above the rate of inflation as measured by the Consumer Price Index. Let me give you 2 scenarios because the outcomes here are actually more nuanced than I think the headlines suggest. In scenario 1, you've got a stagnant market. If a property's value doesn't rise, but inflation does, say CPI runs at 4%, the inflation adjusted base cost of the property effectively catches up to the sale price. In that scenario, your taxable gain could be minimal or even zero. For investors in a flat or low growth market, this change is less punishing than it sounds. In scenario 2, we could potentially have high inflation. If inflation runs at 7, 8, or even 10%, and we saw numbers like that post-pandemic, and the property price growth trails the CPI, then indexation actually compresses the taxable gain significantly. In the high inflation environment, the index cost base rises faster than the property value, which shrinks the gap. Now, here's the critical carve-out. The 50% capital gains tax discount is still available on new builds. So for new construction, investors retain both the negative gearing concessions and the option for the capital gains discount. Now, this isn't a coincidence. This is a deliberate policy setup designed to push investment capital toward new supply. Now, the third change is the one that has flown a bit under the radar, but will still be significant for a lot of property investors who hold assets in trust structures, such as discretionary trusts, of which there's around about 840,000 of them. Now, from now, a flat 30% tax rate applies to trust taxable income, payable by the trustee at the entity level. Now, historically, trusts were not taxed as entities. Distributions flowed to the beneficiaries, who then paid tax at their individual marginal rates. The 30% rate aligns directly with the middle income tax bracket, applicable to income between $45,000 and $135,000. And beneficiaries will receive a non-refundable credit to recognize that tax has already been paid. For lower and middle income beneficiaries, this is relatively straightforward. But there's an unresolved question that I'm surprised hasn't received more attention in the press releases so far. And that's because if income inequality is such a focal point, then this point should have had far more attention around it in the media. So what happens for high income beneficiaries? Above $135,000 in income, the marginal rate goes to 37 cents. Above 190, it goes to 45, plus the Medicare levy on top. If a high income beneficiary receives a trust distribution with a 30% non-refundable credit attached, then mathematically that credit becomes a discount on tax they would have otherwise owed at their higher marginal rate. Now, that could be an unintended benefit. My personal expectation is that actual legislation will start off with taxing the trust's income as an entity, and then personal income to be taxed above the 30% if it takes effect, to require beneficiaries to pay the difference. But this hasn't been confirmed yet, or not that I've seen. And if you have a trust structure, this warrants an immediate conversation with your accountant. Now let's pull all of this together and look at what it actually means for the market. First, there's the supply gap. In the 2024 calendar year, approximately 686,000 residential properties were transacted. Against that, there were only 170 to 180,000 new home completions. And that is already 60 to 70,000 short of the pace required to hit the government's own 1.2 million new home target over its 5-year plan. Run the numbers. Roughly 3 existing homes are being transacted for every new build. Those 500,000 plus established home transactions per year now sit in a materially different tax environment. If investors who are already a declining share of the market step back further from existing properties because the numbers no longer stack up, who buys the homes and at what price? The most likely strategic response is a pivot. Investors are going to most likely redirect toward new build and greenfield developments where the tax environment remains intact. Established suburbs, particularly higher priced, lower yield areas, are going to face a narrower buying pool. In that scenario, sellers may need to reprice, or they may need to wait longer for a buyer. For first home buyers, the picture is mixed. On one hand, investors potentially stepping back from established homes could ease competition in some markets. On the other, existing properties in developed areas are generally more expensive than new builds in outer areas. And that affordability gap doesn't close just because an investor disappears from the buying pool. Now, for renters, the immediate short-term picture is relatively stable. Properties currently held are grandfathered. New builds are still viable for investors, and the rental supply disruption is not going to be happening overnight tomorrow. But as established properties progressively transact under new rules, the pressure is going to probably start to build. A landlord who buys an existing property without negative gearing relief, carrying a cash flow deficit, eventually makes one of three decisions. The first, absorb the loss. The second, exit the market. Or three, raise the rent. In markets with low vacancy, that third option is a potential outcome. And here's where it starts to get really uncomfortable. Using some real numbers, a property currently renting for $630 per week might need to be repriced at $960, potentially $970 per week to make the math work for a new owner operating without negative gearing concessions. Now, that single property might struggle to find a tenant at that rent. But if even a handful of properties in a suburb reprice and the market accepts those rents, the comparables are going to start to shift upward. One accepted higher rent transaction becomes the new floor for the next property that gets listed. And over time, not overnight, but let's say over 2 to 3 or maybe 5 to 10 years, that's got the potential to inflate rents by 20 to 30%. Now let's put that in context for a renter. Assume a single income of $105,000 gross, which is approximately $83,000 net after tax. At $630 per week, rent is roughly around about $33,000 per year. It's manageable, but it's tight. If that same property reprices to $960 to $970 per week, then annual rent climbs to around about $50,000 per year, leaving approximately $32,500 for everything else. And we're talking about groceries, transport, utilities, healthcare, and any attempt to save for a deposit for their own home. This is a savings rate of essentially zero. And a renter who cannot save cannot ever become a buyer. And fewer buyers entering the market in the future means less demand absorption on that supply we're not building fast enough to begin with. Now, this becomes a feedback loop, and it's a slow one, which means it will probably be well underway before most people start to notice that it's actually happening. So where does that leave us? The 2026 budget has not ended property investment like some have begun to say, but it has certainly redirected it. The tax advantages now sit almost entirely with new construction, and the government has been quite deliberate about that, and to a degree, kept existing schemes in place potentially to favour regional areas pushing growth outward from the cities. For existing investors, your current holdings are largely protected, and your strategy review should be focused on trust structures first and then any planned acquisitions of established property later. For those looking to enter the market, the new build pathway has become considerably more attractive relative to established homes, and not just on price. For renters, the pressure is not here today, but there is a potential that it's building. Understanding the dynamics early puts you in the best position to plan ahead. So if you found this useful, make sure you subscribe so you don't miss the next drop, and make sure to check out lawrenceindustries.com for more analysis, commentary, and other short form content. And if you know someone who should be across these changes, share the video. But that's all for today. Thanks for watching, and I'll see you in the next one.